Stop looking at the year 2140. The official story, that Bitcoin's supply runs out in over a century, is now a dangerous distraction. The real supply, the Bitcoin you and I can actually buy, is being drained from exchanges at a historic velocity. While the world is focused on a finish line 100 years away, they are missing the supply crisis happening right now. Institutions are buying it faster than it's being produced, creating a system shock that will redefine who can and cannot acquire this asset. And it determines whether you will be able to afford it or even acquire it at all. What you're about to see is the real story of what happens when Bitcoin's available supply runs out. Let's start with the story everyone knows: Bitcoin's perfect, predictable scarcity. Satoshi Nakamoto designed a system where only 21 million Bitcoin will ever exist. This isn't a promise, it's math, enforced by a global, decentralized network. It cannot be changed, inflated, or printed. This digital scarcity is the foundation of its value, designed to be more like digital gold than a digital dollar. New coins are released through mining. Computers secure the network, and in return, miners are rewarded with new Bitcoin, the block reward. But the genius of the design is the halving. Roughly every 4 years, that reward is cut in half. It started at 50 BTC. In 2012, it dropped to 25. Today, after the 2024 halving, miners get just 3.125 BTC for every new block. This guarantees new supply enters the system at a perpetually slowing rate. Today, over 95% of the total supply has already been mined. The last fraction will trickle out over the next 114 years. This is the narrative everyone focuses on. It makes the end of supply feel like a problem for our great-grandchildren. People ask, what happens when all Bitcoin are mined? And the common answer is that miners will simply be paid with transaction fees. But this entire timeline, the story everyone tells, is a grand illusion. It directs your attention a century into the future, away from the crisis happening right now. Here's the part of the system they don't talk about. Behind the scenes, something is happening that upends the 100-year timeline. While the world watches the slow trickle of new coins, a tsunami of demand is draining the existing supply from the only place it's actually sold. This is where you must understand the difference between total supply and liquid supply. Total supply is the 21 million coins. It's the number everyone knows, but it's largely irrelevant for day-to-day price. It includes unmined coins, lost coins, and the vast reserves held by believers who may never sell. Liquid supply is the number that truly matters. This is the pool of Bitcoin available for sale on exchanges. It's the inventory in the global Bitcoin supermarket. When you buy Bitcoin, you're buying from this liquid pool. For years, this pool was deep. Millions of Bitcoin on exchanges acted as a buffer against large buys or sells. That buffer is disappearing. We are witnessing a historic transfer of Bitcoin from these liquid marketplaces and into deep, cold storage. Digital vaults from which it is not expected to return. And this drainage is happening so fast, it makes new mining look like a dripping faucet next to a fire hose. This is the hidden reality. So, Bitcoin isn't running out in 2140. The available supply is running out now. And the ones doing the buying aren't retail investors. They are the largest financial institutions in the world. So, just how fast are they draining the pool? This isn't theory. This requires looking past headlines at raw system data. And for those who know how to read it, the numbers tell an unmistakable story of a massive, institutionally driven supply shock. The most direct metric: Bitcoin on exchanges. Data from firms like CryptoQuant and Santiment shows reserves have plummeted to multi-year lows, hitting levels not seen since 2018. As of March 2026, exchange reserves hover around 2.7 million BTC, down from over 3.2 million just a couple of years prior. That's tens of billions of dollars in Bitcoin pulled off the market. Now, let's put that in perspective. After the 2024 halving, only about 450 new Bitcoin are mined each day. On many days, institutional demand isn't just outpacing new supply, it is absorbing many multiples of what is being created, eating into the existing liquid inventory at a terrifying velocity. Who is doing this buying? First, the spot Bitcoin ETFs. Run by names like BlackRock and Fidelity, these products are giant, regulated vacuum cleaners for the world's available Bitcoin. In mid-March 2026 alone, these ETFs saw a ferocious wave of buying, sucking in nearly $1 billion in just 6 days. On some days, net inflows have easily topped $199 million. Every dollar inflow requires the fund to go out and buy real Bitcoin from the same shrinking pool as everyone else. The second major force is corporate America, led by Michael Saylor's renamed company, Strategy Inc. A growing number of companies are adopting Bitcoin as a primary treasury reserve asset, not to trade, but to hold indefinitely. In a single week in March 2026, Strategy Inc. purchased another 22,337 Bitcoin for around $1.6 billion. That one purchase is equal to nearly 50 days of new mining supply. As of their March 2026 filing, the company holds a staggering 761,068 BTC. Combine relentless ETF demand with massive corporate buy-ins, and you get a supply dynamic that is fundamentally broken. It's a perfect storm. Exchange reserves are at historic lows, while institutional demand is at all-time highs. This isn't a bull market. It's a liquidity crisis in the making. But this raises a critical question. We see the numbers, we see the drain. But what does the breaking point actually look like? How does a system this big, this global, actually run out of inventory? Knowing that a supply shock is happening is one thing. Understanding how it breaks the system is another. The sequence is logical and predictable. The system doesn't just bend, it snaps. The shock isn't triggered by the final coin. It's triggered when the liquid supply on exchanges evaporates to a critical point. It's a bank run in reverse, a global run to acquire an asset. As institutions pull thousands of Bitcoin into cold storage, the order books on exchanges get thinner and thinner. The wall of sell-side liquidity that once absorbed large buy orders is being systematically dismantled. This leads to the trigger, the no sellers moment. It's not a literal moment of zero sellers. It's when overwhelming buy-side demand collides with an almost completely depleted pool of willing sellers at current prices. For months, the system feels stable. The price moves, but orders get filled. Then it becomes fragile. Large buys start moving the price in ways they never did before. The order books get visibly thin. And then, the break. One morning, a massive wave of ETF buys collides with a new corporate treasury announcement. The buyers arrive, wallets open, but the shelves are bare. This is the break. It isn't gradual. An order that should have moved the price by 0.1% a year ago now ignites a 5% cascade in minutes. Buyers are forced to chase the price violently higher, trying to find anyone willing to part with their coins. Short sellers are instantly liquidated, which forces them to buy, adding more fuel to the fire. The preconditions are already here. The remaining long-term holders have proven they won't sell for anything less than a life-changing price. The new dominant players, the institutions, are explicitly long-term accumulators. When an unstoppable force of demand meets an immovable object of supply, the only thing that can give is the price. And it will give in a way that could shock the global financial system. This supply shock won't just create a new all-time high, it will trigger a fundamental, permanent repricing of the asset. The implications will ripple through all of finance. First, price. Wild forecasts are often logical extrapolations of this supply crisis. When demand from just two sources, ETFs and corporations, is already absorbing multiples of the new supply, a violent repricing isn't just a possibility, it's a mathematical probability. The market will be forced to find a price high enough to convince the strongest hands to finally sell. Nobody knows that price, but it is likely orders of magnitude higher than today. This isn't just another bull cycle. The halving created a supply shock that took months to play out. This new institutional shock is a continuous, daily event layered on top. It's a double squeeze. Cycles could become more aggressive and corrections shallower, because any significant dip is now met with a wall of programmatic institutional buying. But the most profound implication isn't price, it's availability. For the average person, this will feel like an availability crisis. Imagine trying to buy a house in a city where investment funds have bought every home with no intention to sell. That is the future of the Bitcoin market. You might log on to an exchange and see a price, but the order book is terrifyingly thin. Buying even a modest amount without causing massive slippage will become a luxury. There could be periods where, for all intents and purposes, you simply can't buy. The story shifts from Bitcoin is too expensive to Bitcoin is unobtainable. This leads to the final shift. Bitcoin completes its transformation into a global, institutional-grade treasury reserve asset. Its primary role becomes the base layer of a new financial system, a store of value so scarce that nations and corporations use it as their ultimate reserve. The money flowing in is getting stickier with every purchase, creating a permanent base of demand. The window to easily acquire this asset is closing far faster than most realize. So, what's the takeaway? Forget the story about 2140. The real countdown clock isn't on a calendar. It's the balance of Bitcoin on exchanges. The data shows the available supply is being systematically drained by the largest financial players in the world. This is not another market cycle. This is a structural liquidity crisis, a collision between relentless institutional demand and a finite, immovable supply. The inevitable result looks to be a system shock, a violent repricing that will redefine Bitcoin's role in the world. It will mark the end of easy accumulation and the beginning of an era where availability, not just price, is the dominant concern. The daily price is noise. The charts are a distraction. The only signal that matters now is the dwindling balance on exchanges. That is the real countdown. And while everyone is watching the clock is watching them.